Hey, this is Tim, loan officer, and I help people build equity and wealth through home ownership. Thank you so much for watching. So, the last two videos, we talked about how to read a loan estimate and a closing disclosure. And what I realized is that, yes, I'm showing you how to read it line by line, but the issue is you're not just concerned about knowing how to read it. A lot of people want to know, are they getting a good deal? Are they getting a good rate? I mean, think about it. Reading something, it's one thing, but understanding that you're not getting taken advantage of and they're giving you a fair rate and not charging you too much, that's a whole nother conversation. So in this video, this will be, I think, part 3 and conclude the series. And this is going to focus on, are you getting a good deal? Are you not getting taken advantage of? Because we have the whole 2008 and the subprimes, and there's a trust factor in the mortgage industry. So let's talk about that. And that's what this video is going to be about. So let's get into it here. And what I did here is I made a list here. It's a list to steps to getting the best deal. Now, the first thing you want to do is just review the loan estimate, okay? You want to review your loan estimate. See right here, loan estimate. That's the first thing. After you review it, this thing you want to focus on is section A on page 2. So let's go there real quick here. Let's go to page 2. And this is section A. And the reason you want to focus on this section here is because this is the section that the lender can control. Lenders can waive their application fee. Lenders can give you a lender credit. See down here where it says lender credit? So there's a lot of competition in the mortgage industry. And, you know, we all want your business. We all want to earn your business. So the first thing you need to do is read the loan estimate, review it, understand it, look at section A, and see here it's $1,800. Second, you want to write down your questions and talk to your loan officer. So you want to talk to your loan officer and you just want to ask them, hey, how did you come up with that interest rate? How did you, and then real quick here, page 3 will have his contact information, okay? That will be the contact information and the phone number. So you want to ask some questions. Now, if you do have, bad credit or a very low down payment or some collection, things like that, then it may make sense that you're not going to get the lowest rate. But don't focus on the rate. And remember, a rate is a feature. It's a side product. The goal is for you to get the home. You get the home, you make some payments. Guess what? Your balance goes down. You have equity, and that's called loan to value. And that's going to help you refinance to get a lower rate. So if you can get the home, get the home. Don't not get the home over interest rate, okay? The interest rate is secondary. Number one is, do you qualify? That's the number one. Second is the interest rate and costs and things like that. And I want to break down real quick, how did we get rates? So a rate, is based on a couple of things here. First is based on your credit. That's number one. Then a rate is based on loan to value, or that would be your down payment. Let's just put that here. Down payment, okay. Let me just that's not how we write loan to value. It's loan to value. There we go. It's also a rate based on the market. The market. So the market's high, Not that you can do about it. And then lastly, it's based on the lender. Yep. And then also, I missed one, debt to income. There's a lot of factors that go into interest rate, and we don't manually put in it. The computer calculates interest rate. The computer says, hey, this is the rate the client qualified for, And then if the client has more money, they can pay more money to get this rate. That's how it works. So let's say you review the loan estimate, you ask your questions, and you're still not happy. Now you go to number 3, check Google rates and rate table. So let's go do that one real quick here. So it's not hard. You go to Google, you type in today's mortgage rates, you put in, this information here, and this should give you a good ballpark. Secondly, you can go to bank rate, bank rate. If you go to bank rate on Google and you click there, right there, and then you would click purchase because that's what you're doing here. And another thing too, you can shop for credit cards, CDs, you can shop for equity lines of credits and second mortgages, investments, and all kinds of stuff. So the more knowledge, the better. But today this will be a purchase. So you get purchase, same thing. You can put in your zip code and some of these factors here. And all this is doing is going to give you a base point. Now, if you look here, this is saying points. 7,000 points. That's too much, almost 2 points. So, yeah, you can get that rate, but you're going to pay $7,000 for it. You see how that works? So you may not want the lowest rate, especially if you don't have $7,000. But I wouldn't recommend paying $7,000 for an interest rate. What you do is wait until the market goes down, for recession, COVID, anything, and then you refinance. And you don't have to pay $7,000 if the market goes down. Another thing you can do is go to Rocket. You just type in Rocket rates. Rocket's a big lender. So you can do one of these or all these. You don't have to do all these, but I'm just giving you all the information. As you see, Rocket, if you put purchase here, it's going to give you rates and costs. See, $6,000 for 6.5. It's going to give you rates. Same thing with Bank of America. You put Bank of America rates and you click on that. Okay, so you got it. So that's what you do there. And let's go back to the list here real quick here. And then if your rate right here is, off, let's say off by, 0.5, I would just leave it. I mean, but if it's any more, if it's more, let's say more than 0.5, then I would go to the next step. I would contact one of these, whether it's Bank of America, maybe Rocket. Do not put your information online, like especially here, because you're gonna get a bunch of phone calls. But it has the name of the company, so you just take the name of the company and call them. Call the company directly. Call this company directly. And what you want to do is let them know you're working with another lender, you have a loan estimate, and you want to send them only these 3 pages here. And they're going to go ahead and pull your credit, and they will provide you with another loan estimate. And now you have a choice. You can work with that lender that gave you the new loan estimate, or you can go back to your first lender and say, hey, I got a little bit better offer. And 9 out of 10 times, they're going to either match it or beat it. And on average, it usually saves you about $1,000. It's not going to be huge because interest rates are based on the 10-year treasury. And you can check that too. The market's closed today when I'm recording this on a Saturday. But you can check here. This is the 10-year treasury. And you see it went up and down. See that? Let's go back. Let's look at the last 5 days. It's not working right now. Okay. But you can check the last 5 days, last year to see the market. But yeah, that is how you get the best deals step by step. And it's not a bad idea to shop, one lender, but you don't want to do more lenders because each lender that you shop is going to run your credit. And what happens, you get too many hard inquiries. It's just not good. It can make your credit go down a little bit. So you can easily do some research in 10, 15 minutes and figure out if you can get a little bit better rate, a little bit lower payment. Thank you so much for watching, and I hope this helps. But if you follow these steps, you will get the best deal and nothing to worry about. And it never hurts. The main thing, too, I want to talk about this real quick, is your program. So that your loan program, sometimes another lender could have a different program that's good for you. Or that lender could have a little bit lower cost for the same rate. Remember, some lenders give you higher rates and lower costs, and some lenders will give you a low rate with high costs. So that's kind of how it works, like a teeter-totter. But I know you don't do this every day, but this will definitely set you in the right path. Sometimes have another lender just take a second look at it, double check it if they come back with the same program and a little bit lower rate. And one more thing too, be cautious, because sometimes you can go to another lender and all he's doing is charging you more points but giving you a lower rate. And some people may not notice that. So that's a trick sometimes, because lenders are all tied somewhat to this market, but some lenders, do want to earn business, and they will cut into their margin and give you the same rate lower because they want to get your business. So I hope this helps. Don't get overwhelmed or confused, but let your loan officer know that you may talk to another lender if he doesn't give you a better deal. So you can do that, but be really nice and respectful. All right, that's all I have for you. Thanks so much. I'll see you again on the next video.